Hi, I'm Mark King, Investment Editor at Columbia Threadneedle Investments. Joining me today for a special discussion on the investment outlook for 2017 is Mark Burgess, Chief Investment Officer EMEA and Global Head of Equities. He's joined by William Davies, Head of Equities EMEA, and Toby Nangle, Head of Multi-Asset Allocation. So Mark, 2016 could be characterised by political uncertainty and rising populism. We had Brexit and the election of Donald Trump. Do you see this continuing into 2017?
Well, certainly we've got 3 more European elections next year, starting with the Dutch election in March and then the French presidential election and then the German election sometime in the autumn. So we have the possibility for another populist uprising, if you like, in one of those 3 important elections for Europe. I think the critically important thing is that were we to get a rejection of the establishment in the way it manifests itself in one of those countries, then that could put some pressure on markets, because the UK leaving the EU is one thing and Donald Trump's another thing, but certainly a constituent of the Eurozone voting to leave would be a seismic event.
Are you expecting a shift from monetary policy to fiscal in 2017, and what are the repercussions if that takes place?
Well, we've seen markets sort of starting to think about that, particularly in the US, where Donald Trump's policies look to be relatively expansionary, with both the cut in taxes but also an increase in spending. How much of that sort of feeds through into 2017 is debatable, because I think much of the first part of the period will be him bedding down and lining up his policies and looking to get them voted through. So we may not see a big impact in 2017. Outside of the US, certainly in Europe, there is a growing call for more fiscal policies, and austerity is beginning to get a bit tiring for many people, I think. But the room for manoeuvre is quite limited, because governments are relatively indebted and there's not a lot of scope for them to raise spending. So I don't think it will be quite so significant in Europe.
If there is fiscal, that's potentially inflationary and a challenge perhaps to our lower for longer scenario. Do you think that sort of central case will be challenged in 2017?
Inflationary pressures do feel like they're bubbling away a bit more than they have done historically, but it's still relatively modest. And I think you can see certainly interest rates going up gently in the United States next year, but again, I don't see European interest rates going up anytime soon. I don't see interest rates going up in Japan anytime soon. And I don't see interest rates going up in the UK anytime soon. So outside of the US, I think interest rates remain low.
William, what impact do you think President Trump and US policy will have on global equities?
Well, I guess we've seen a slight change with the success of Mr. Trump in the US election, and as Mark has alluded, I mean, if anything, we expect that to lead to stronger growth in the US, at least short term. Because his policies are certainly expansionary. Those of spending more and cutting taxes ought to lead to stronger growth as we go through 2017 and into 18, probably more of an effect. And with that, interest rates will rise. Maybe the yield curve will get a bit steeper. And with that, you look at US companies, you look at, say, the US financials, and they'll benefit from wider margins, but higher margins as we move forward. Maybe the regulatory risk will be a little bit less as we go forward as well. Some of the US industrials can benefit from this also. So short term, you look at the impact on the US market, and we've seen the US market rise since the election. There's probably a bit more to go for in that respect. But as Mark also said, that doesn't necessarily mean that we think growth is going to be really strong elsewhere around the world, and interest rates will probably remain lower in Europe, in Japan. So maybe there's a potential possibility or potential for the Japanese market. We've seen the yen weaken since Trump was elected. Maybe there'll be a bit of reflation there and stronger growth there. And that could be an area which benefits as we go into 17.
Talking about the rest of the world, where do you see opportunities in terms of regions and specific sectors?
Well, we mentioned the outlook for Japan maybe gets a little bit more attractive with the weaker yen. I think, as Mark's mentioned, in Europe, I guess the political landscape is one where there are threats out there as we go into 2017. But let's not forget that people know about these elections. So if Europe does what it does best and muddles through 2017, then actually that's a bit of a positive for Europe, we would say.
Are you worried about China at all, William?
We spend our lives worrying about China, and that's been a common theme over the years. But if we look at consumption growth within China, that remains pretty steady and pretty attractive. So yes, we've seen fixed asset investment fall, or at least the level of growth in that fall. But by and large, we're quite constructive about the Chinese economy, driven by consumption.
And Toby, there's been a lot of discussion about the bond market in recent months, and perhaps we're edging closer to the bond bubble bursting. What would be the triggers for that, and do you see it happening in 2017?
Well, over recent months, we've seen bond yields start to rise across the globe. That's partly due to reflationary moves with higher commodity prices. It's also a move away from austerity and towards fiscal expansion, all of which is quite reflationary. We've seen bond markets for a number of years having the Federal Reserve move towards them in not raising rates, and that's starting to go the other way. There is potentially quite a long way to go from here, depending on how things pan out.
On a valuation basis then, do you favour equities over bonds for 2017?
Equities are actually quite attractively priced versus bonds, but we have to remember that that is on a versus bonds basis. So on an overall basis, if we get earnings growth coming through, equities look quite attractive, and our teams are looking for some good earnings growth in some select areas. But the picture isn't uniform, and so there'll be great opportunities to allocate to those areas that we like best.
Given everything we've spoken about, how will you manage your asset allocation in 2017?
We've got some really good opportunities, we think, from both a valuation and an earnings perspective in Japan. The policies that Mr. Trump is putting forward would actually be quite positive for earnings of US companies just from the taxation agreement alone. And within the UK and Europe, we're actually seeing relatively good earnings revisions coming through. So there's some interesting opportunities in different parts of equity markets. On the fixed income side, we're not using long-dated bonds in any meaningful way within our asset allocations. But that's not to say that the opportunities within fixed income are completely empty. And so we're blending these things in quite a tactical way, and that's been very, very helpful in 2016. We hope it will be helpful in 2017 also.
And if you've been looking at the commodities market at all, what does that hold?
Commodities earlier this year staged a real turnaround, and that's been extremely helpful for certain parts of equity and fixed income markets as well as commodity investors themselves. Commodities are an area that we actually quite favour at the moment and have been increasing our allocations to over recent months.
Mark, what do you see? Where do you see the opportunities in 2017? What are you most worried about, and what are you most optimistic about?
I'm probably most worried about a party with an out mandate getting voted in probably either Holland or France, because I think that would place quite a lot of pressure on the European financial system. That would be a global event and would be very unsettling for markets. But as William said, Europe's got a very long history of muddling through, and if we don't get that, then given how beaten up many people feel about the outlook for European equity markets, there's potentially some upside there. And similarly, you know, the tightening that we're seeing in the United States is a reflection of an improving backdrop for growth in the US economy, and that has to be a positive, coming off the life support of extraordinary monetary policy. After 8 or 9 years of QE, has to be seen as a positive.
And Toby and William, do you see opportunities also and key risks?
I think if we look at those opportunities, those come from the stronger growth, which we would expect in the US in particular. But in terms of the threats, we have to recognise that protectionism is rising, or at least the threat of protectionism is becoming a bigger threat. And so longer term, does that spell a reversal of globalization? To me, that would be the threat as we look out a couple of years in the future.
I'd really share that concern that much of the re-rating of bond and equity markets that's come over the past 20 years or so have been associated with falling yields and falling inflation expectations, very much being tied up with the move to globalization and the increase in technology. Now, It's not as though we're going to completely unwind globalization, but you actually need to get more countries joining the global trading system for that to continue. And if we just freeze as we are, then that's actually can be quite dangerous, I think, for markets over the intermediate term.
I mean, this environment sounds like one that's ripe for active stock pickers and active managers to be flexible and agile, and this is obviously where your strengths lie. So good luck, and thanks for watching.